In this chapter, we're going to take a closer look at plant assets. These are the assets in the classified balance sheet under property, plant, and equipment. All of these assets get depreciated based on their use. To do that, we have to show you some of the depreciation calculations and understand some of the other terms that go along with this. So go through and make sure you understand what a plant asset is, how you evaluate historical cost. Know that land improvements will be depreciated, whereas land is not. Make sure you understand that. Understand the difference between ordinary repairs and capital expenditures. Ordinary repairs are an expense, whereas capital expenditures typically extend the life of the asset and therefore are depreciated. But again, make sure you go through in your own words, explain these concepts so that when they're embedded into a problem, you understand what to do with them. And make sure you also understand that anything that goes into the cost of an asset to get it intended for use also goes into the cost of the asset and is therefore depreciated. For example, one of the things that we sometimes see is like demolishing a building to build the next one. You have to get that up and running and ready to build the other building. So that goes into the cost of that. Or other things, one thing you'll see is grading of land, making sure it's level, things like that. Anything that goes to get it ready for use goes into the cost of that asset. We're going to talk about depreciation methods in detail in another video, but these are the terms you have to know to understand these depreciation methods. Understand what depreciation is. This is the use of an asset. It's how we show an expense related to the use of an asset which generates revenue. The book value is cost minus accumulated depreciation. As a reminder that accumulated depreciation is that contra account that attaches itself to the asset and carries the amount of depreciation expense over the asset's life. Cost is your historical cost. Useful life is how long the company plans to use the asset for. It may be still useful after that, but it's how long the company plans to use the asset. Your salvage value is going to look at how much you think you might be able to get for this asset once you're done using it. And then we have 3 different methods of depreciation that we'll be going over in detail, and then understand the term impairment. Of course, there's journal entries that go along with depreciation. We've done these before when we talked about adjusting journal entries at the end. We're going to debit that depreciation expense, credit your accumulated depreciation. So that should be a review for you. Now, disposing of assets when we're done using them can create a gain or a loss. You have to understand the book value of an asset to understand if it's a gain or a loss on what you're getting. So to determine this, you're going to compare the cash you get versus the book value. And that will determine whether you have a gain or a loss. If your cash is higher than your book value, you have a gain. If the cash you get is lower than your book value, you're going to have a loss. So let's look at these journal entries to dispose of an asset. And I have these set up a little bit differently, just so you can kind of see the similarities and at least have something to start with on each and every one of them. So every time we get rid of an asset, we're closing it out, bringing that balance down to 0. And to do that, every time we have to debit that accumulated depreciation account and credit that asset account. It doesn't matter if we know we're having a gain or a loss or nothing at all. We have to debit accumulated depreciation, credit that asset account. Even when it's fully depreciated, that means you're not getting any money for it. You're just getting rid of it. It's completely done. You're going to debit that accumulated depreciation, credit that asset account. And the asset account could be equipment, it could be machinery. That's why I just put the word asset there. The next thing you're going to realize is if you have a gain or a loss, you're probably selling this asset. Therefore, you're going to get a cash amount. That's going to be a debit. So that's going to happen also no matter what. The final piece is whether or not, again, is the cash we're getting greater or less than the book value. Remember, we have to make our debits must equal our credits. So that's another way to look at it. If you have a gain, you're going to credit that gain, which means that you needed a credit here to make my debits equal my credits. Here, my credit's going to be higher. I need another debit to make sure that those agree. If you have a debit here, it's a loss on disposal. So again, you can look at the book value, which is cost minus accumulated depreciation, and your cost is your asset value. So really, we're just looking at these journal entries. And then we can determine, based on how much cash we're getting, if it's a gain or a loss. If, for example, we are going to get rid of this asset prior to its full depreciation, meaning we did not use it for the entire useful life, again, you're going to debit that accumulated depreciation, credit that asset account, but since we're getting rid of it prior to its full depreciation, we're always going to recognize a loss. And that's going to be a debit. There's a couple other concepts in this chapter. One of them is defining natural resources and intangible assets. These are still used and need to be recognized as being used. When we talk about depletion is a natural resource that we're extracting from somewhere. For example, like coal or oil. This adds to our inventory when we take it out. So we're going to debit our inventory and credit accumulated. This is not depreciation, it's depletion account. Again, same kind of concept. It's that contra asset attaches itself to that asset that we own. This is just recognizing that we're using some of that asset. We'll actually get expensed when we sell that inventory. And amortization of an intangible asset. Remember, intangible assets are like patents or copyrights. Those typically only last for a certain period of time. Therefore, we want to show that part of that time has been used, and therefore we're going to debit our amortization expense, and we'll just credit that asset, which is like whatever, a patent or whatever intangible asset we're talking about. And then this chapter does then go back and review that classified balance sheet, adds in that accumulated depreciation account, takes a look closer at those plant assets, and just kind of reviews this topic that we've already learned about. That should be it. There's another video for this example because it's a longer example. I wanted to make sure you had time to stop and go through it. So you can either try to complete this yourself and then review that video, or watch that video and walk through it with me. Let me know if you have questions.